Everyone, welcome to our Solo 401k and Self-Directed IRA Q&A session. My name is Natalie with Sense Financial, and we are a boutique financial firm specializing in self-directed retirement accounts with checkbook control. Just want to make sure that you all can see and hear me okay. If there is any issue with that, please let me know in the live stream chat. Kimberly here responded yes, so thank you for that. Appreciate it. Also, if there are any additional questions that were not submitted at the time of registration, again, feel free to type them up in the live stream chat at any time, and we will answer those today. I am here today with Dmitry Fomichenko. He will be answering all of the questions. Dmitry is the founder and president of Sense Financial Services. He began his career in financial planning and real estate investing in 2000. He owns multiple investment properties in various states and is a licensed California real estate broker. Dmitry holds a designation of Certified IRA Services Professional from the American Bankers Association, and over the years he has taught hundreds of investment and financial planning seminars and has mentored thousands of investors. Thank you for taking the time to join and answer all the questions today, Dmitry.
Oh, sure, Natalie. It's a pleasure to be here with you and looking forward to the questions. I took a look at them ahead of time, and there are some good ones.
Yeah, we'll jump right in. First question here is from Victor. He's asking, are there ways to reallocate profit from a solo 401k or self-directed IRA to a Roth self-directed plan to minimize tax?
Good question, Victor, but unfortunately there is no way to reallocate the profits from your Roth portion of your solo 401k or from a pre-tax to a Roth. That's not going to work. What you may want to consider is doing a Roth conversion. And I talked about this in the past, but you can do a Roth conversion not for the cash, but for an asset. So when you invest in an asset, and as it works only with certain assets, not going to work with everything, but with certain asset. And something that I learned from a client of mine, I personally have done it. You can invest in a promissory note or a trust deed or a mortgage, and then you can value that mortgage or that note, and it's valued at the discount typically because it's a liquid. You can get about 30% discount on the valuation. And I actually have done it once for a note that was defaulted, and that came in at about 65% discount. So this is a great way to save on taxes, and you may want to consider that, but there is no way to reallocate the profit from a traditional portion to Roth directly like that.
Next question is from Sapash. Is one required to file a tax return for the LLC used to buy rental property with the self-directed IRA funds?
Good question. So the only return that is required is not a tax return, but because LLC that your IRA owns is considered pass-through. The IRA is the single member, so it's taxed under members level, which is the IRA, and it's tax exempt. However, if the property that you buy uses leverage inside of an IRA, there is a unrelated business income tax that may apply if you buy leveraged real estate. Solo 401k is exempt from that, by the way, so that's another reason why it's superior to an IRA. But if you own a rental property with leverage, with loan on it inside of an IRA, then you will owe unrelated business income tax on the portion of the income that you receive from the leveraged portion of real estate. And you need to file a Form 990T. So you do want to check with your CPA. If your CPA doesn't know how to do that, you may need to find one who does. But that is the form that is required only on leveraged real estate, or if you're IRA investing in some kind of a active business activity, then that will apply as well.
Okay, question from Robert. My wife has inherited an IRA from her father and would like to use the funds to purchase a rental property. We will still need a loan for this purchase and would like to know how to proceed. Also, once purchased, how will we handle the required minimum distributions?
Good question, Robert. So if you inherited an IRA from, there is a distinction that needs to be made, is who the IRA was inherited from, because it's treated differently. If you inherit an IRA from your spouse, then you can convert that to your own. So basically, you can treat that as your IRA. You can rename it and make it your own IRA. It's going to be in your name. If you inherit an IRA from anybody other than your spouse, then it has to be inherited IRA. The inherited IRA remains to be in the name of the deceased. So it's going to have your father-in-law name on the account, and your wife will be the beneficiary. So as the beneficiary, she controls it. One thing when it comes to the required distributions, if your father-in-law was at the age where he was required to take RMD, then your wife will have to take annual distributions from the IRA. If he wasn't at the RMD age, then your wife will have 10 years to distribute the entire IRA. So basically, IRS wants inherited IRAs to be emptied within the 10-year period. So keep that in mind. Now, if you're looking to buy property, that can work nicely, assuming he was prior to the RMD age. If he was over, it still might work. You just need to do more planning. Make sure you run the numbers so that you can meet the criteria. It's probably going to be challenging in this case, but you got to run the numbers regardless. If he wasn't at the RMD age, then you have 10 years. So you can buy a property, you can rent it out, and 10 years is a good period of time, depending where you buy, but in many areas, property can double in value over a period of 10 years. So you can certainly get a nice, good run there. As far as taking a loan to acquire the property, whenever you buy property inside of a retirement account, you personally not allowed to provide guarantee for the loan. So you cannot use conventional financing. It has to be non-recourse loan. And we do have a list of non-recourse lenders on our website. You can head there, you can take a look at this list, contact those lenders, and arrange the financing with them. But the bottom line is non-recourse means that the lender doesn't have any recourse against the owner or any other assets. The underlying property is the only security for the loan. That's what non-recourse means. Most lenders do not do those loans, so it's only specific lenders that will be able to help you. And again, we have pretty complete list on our website. You should be able to find a lender that will work.
Okay, a question here from David. I only have $28,000 in my solo 401k and had no activity in the account for 3 or 4 years. Do I need to pay the yearly fee to Sense Financial to manage it for me?
David, if you have a solo 401k, there is basically two ways to establish a 401k plan. And in your case, you're using Sense Financial as the document provider. The other option is to get your own plan, which can cost you thousands of dollars. So that's not efficient with the small business owners. But if you are using Sense Financial prototype plan documents, then we have to maintain that. There are certain requirements that IRS obligates us to do. So as a plan document provider, we're required to report your plan to the IRS. We're required to keep your plan documents updated to ensure compliance with the IRS. But if you only have $28,000, I don't know what investments are there. If you don't have any alternative investments, and if you don't intend on investing in alternative assets, you can easily switch to an IRA. We can help you do that. but it seems like you might benefit from that speech. I don't know the details, um, but feel free to give me a call, and I'll be happy to chat with you about your specific situation. And I always do what's best for a client. Um, we may end up losing you, but again, if you share with me your details and you'll benefit from just a regular IRA, we'll be happy to help you. Because again, we want to do what's best for you.
Okay, a question from Kenneth. Can you give an example of a self-directed loan to private individuals?
Uh, the question is a little bit unclear, Kenneth, but I'm going to try to answer that to the best of my ability. I'm going to try to maybe read in and maybe guess what you mean by that, but you can use your self-directed IRA or 401k as a bank. So basically, your IRA or 401k can be the lender to other individuals. Now, you do want to avoid giving non-secure loans. If you're giving non-secure loan to anybody, it doesn't matter who that is, then you got no collateral and you have a high risk. So I'd stay away from those. But what's common between many self-directed IRA account holders, and I've done it myself a bunch of times, probably over 40 times over the last 10 years. What you can do is you can lend out secured notes. So basically, you become, again, the mortgage company or the bank for those individuals. And there is situations where people they either want to buy a property or they want to maybe pull out some equity, and they don't have the ability to qualify for a conventional financing, so they go to the secondary. And that's where you can step in and be that private lender. You do need someone to draft the documents for you. You do want to use escrow or a title company to facilitate the loan. That's for protection for the lender and for the borrower. And they'll draft the paperwork. You'll wire the funds to escrow, and the escrow will advance the funds to the borrower. But it's pretty much the same way that you would facilitate the loan if you used your personal savings. Here, it's just going to be your retirement account who will be the lender. But yeah, use the title company or escrow, and they'll guide you through the process.
This question is from Joseph. What are the steps to fund and retrieve redemptions and tax liens with my solo 401k funds?
Good question, Joseph, but I'm not a tax lien expert, so this is an investment question. It has nothing really to do with the solo 401k, so the process will be the same as if you were doing it with the personal funds. So I'm unable to answer this question because, again, I don't have any expertise in tax liens.
Okay, next question is from Mary. What is the minimum that can be moved from a 403b?
What is the minimum to be moved from a 403b? I'm assuming you wish to move that to either self-directed IRA or self-directed 401k. There is no minimum from the IRA or 401k standpoint. Now, there might be certain restrictions with the 403b plan. So you want to reach out to the 403b plan administrator and inquire with them. But typically, if you're still employed and you're under retirement age, you're not going to be able to move. In most cases, there might be exceptions. There might be a certain amount that you will have vested and you'll have access to, but you do want to inquire with the plan administrator. And if you're no longer working for that employer, in other words, if it's a past employer for a 3B plan, then you should be able to move that without restrictions. Typically, employer-sponsored plans, I've seen that they do require you to move all of it. So there is no minimum, but basically you have to move in the lump sum. And you don't have to move all of that into self-directed. You can split that. You can move portion to just a regular IRA at Fidelity or Vanguard, and then self-direct the portion of that. But the bottom line, with the 403B, there are exceptions, and I'm sorry, there are limitations with the employer plan. So what you can do is you can move it to an IRA. You're going to have more freedom with just a regular IRA, more investment choices. It'll be limited to the stock market, but you'll have more choices of mutual funds and so on. And you can also take portion and move that to a self-directed account as well.
Okay, question from Ernie. When buying crypto through my solo 401k, do I need to buy a cold wallet?
Well, if you're you can buy crypto in your 401k, and there are various ways to do that. You can use an exchange, or if you're gonna store that currency in the wallet, then yes, you will need a separate wallet from your personal. If you invest personally, you cannot use that wallet for your 401k assets. Because you're not allowed to commingle 401k with the personal assets. So yes, you will need a separate wallet for it.
Okay, next question here is from Elisa. I'm 59 and wanted to see if I should be doing something different with my account.
Not really, Elisa. With reaching a retirement age, you have the ability to take distributions without being penalized by reaching normal retirement age. But you don't have to do anything different. You don't have to take distributions. It's when you reach the RMD age, that's when it's going to be different. And RMD stands for required minimum distributions. So at that age, you will be required to take certain amount. And just to also educate you a little bit, if you have an IRA and you're taking RMD, and you have multiple IRAs, you can actually take RMD from just one IRA to satisfy RMD requirements for all, because they're lumped together. However, if you have a 401k, the 401k RMD rules apply just for the 401k, so you cannot count IRA in, and you have to calculate and take the RMD just from the 401k. So be sure to plan for it. The key here is to plan in advance.
Okay, we have a question from Adam, and he's asking how to do tax filing for self-directed IRA. What are the documents needed? Are there any tax software recommendations, or do I have to go through a CPA? And how do I identify the right CPA for self-directed IRA tax filing if needed?
It's a similar question to the one I addressed earlier today. If you have a self-directed IRA, there is no tax filing requirements that you need to do unless there is either debt financed income or there is a business income. So if you invest in real estate using leverage in an IRA, UBIT will apply. And if you invest in an active business, then UBIT will apply as well. And in this case, you need to file Form 990T. Again, that's the only form that is required, and you need to find a CPA who knows how to do it.
Okay, question from Lynn. I am the trustee for my solo 401k with all my business, with my small business as the adopting employer / administrator. If I was 1065 Partnership LLC, then 2 years ago changed tax election to an S corp. Do I need to make any changes to my solo 401k, how my solo 401k is titled? The EIN is unchanged, so it is correct that. So is it correct that this change is the only change in tax election with no other updates needed?
Well, a little bit longer question, but to summarize it is that your business unchanged except the tax election. So it's the same business. You had an LLC, which was taxed as a partnership, now LLC, filed for S corp election. So it's the same entity, the same tax ID number. Your 401k will not change. It's not the way it's titled is not going to change. And by the way, even if you change the sponsoring business, let's say you had LLC and then you dissolved that LLC and you started a new business. Now it's a corporation. That's not going to affect the titling of your solo 401k plan. Now the plan needs to be amended to reflect that change in the plan sponsor, but the titling of the 401k itself is not going to change. In your case, though, it's the same business. Now what's going to change is the way you're going to make contributions, because with the partnership, you could just make elective deferral contributions based on your net self-employment income that was reported on your tax return. In this case, when it's an S corp, for S corps, your contribution is defined as the salary that you take from the business. So basically W-2 wages that you're paying yourself from the company, that's what the elective deferral contributions will be based or will be taken from, and the profit sharing contributions will be based on that. We do have a detailed guidance on this on our website. We have just some basic information, and then we have a lot more detailed guidance on the client portal on the contributions. So be sure to review that. Go to the client portal and search for, I think it's contribution basics or applying for contributions. That's the name of the article. It has a lot of good information on how to handle, but your plan doesn't have to be changed.
Okay, next question's from Brent. I'm 56 years old. I've had precious metals in a self-directed IRA and in my possession for a couple of years now. Can I close my account with the custodian to avoid the quarterly fees without any kind of penalties?
Well, Brent, bad news for you. You messed things up. You cannot have precious metals that your IRA owns in your possession, so you're in violation. You committed a prohibited transaction, and you got bigger problems to worry. Not just eliminating the fees from the custodian. You can eliminate the fees by taking the distribution, and maybe that is what you should do. But you're under retirement age, so taking early distribution will result in penalties plus taxes. I don't know if you're our client or just joining here for some guidance, but you're more than welcome to reach out to our office and speak with one of our experts, either myself or Brad. We can help you and guide you.
Okay, next question's from Eden. I have a 401k after leaving a company, and the new job doesn't offer 401k. What happens to the original 401k?
Well, even if you left the employer and you now with the new employer, and that employer doesn't offer a 401k, which is kind of irrelevant here. If your new employer offered the 401k, you will have the ability to take the old 401k and move it to the new one, which is not advisable because, again, employer 401ks, they have restrictions. There is less choices. So you can take your old 401k and you can move that to just a regular IRA at Vanguard or Fidelity and invest in the market. Or now that you're no longer employed and it's a past employer 401k, you have the freedom to also self-direct those funds. You can establish self-directed IRA or solo 401k if you're eligible, and you can do a direct rollover from that old 401k to the new self-directed plan, and you can now invest in alternative assets, and you can be truly in control of your investment choices.
Okay, this question's from Sam. How do I take an RMD if all the funds inside my self-directed 401k are invested in real estate?
Well, another RMD question, and it's probably good to talk about this every Q&A session because it always comes up. The simple answer is to plan for it ahead of time. Now I'm not sure where you're at. You're just asking the question. Maybe you are planning, which is good if you are at the RMD age and you've got no cash, and then you it might be challenging. Now, again, the key here is to plan ahead of time. Don't wait until you turn 73 to plan for RMD. Do it when you turn 60. And that's thinking about the kind of assets you will have at the time you will be required to take RMD. It will be time to think about what kind of income you can expect from the investments. The ideal scenario is that you have enough investments in your IRA. Let's say you have few paid off rental properties, maybe a few private loans that you made out, and you receive income from those assets, and that's enough to pay for your living expenses, and that's enough to satisfy the RMD requirements. So this way you can just take the income out as the RMD without touching the principal or the assets. Now, if your RMD is more than what the income that your assets produce, then you're going to have to do something. You either will have to liquidate to get some cash, or potentially you can take in-kind distribution where you can take a portion of the asset out. So for example, if you own a rental property in your IRA, you potentially can take 20% of that property out of the IRA, and then that asset next year will be owned 20% by you personally and 80% by the by your self-directed IRA. Now that's going to be tricky because now you're going to have to split that, the income and expenses. If you have a property manager, that's easier because they can handle everything for you. But the bottom line is you got to plan for it ahead of time. And if you didn't, then you'll be forced to liquidate, which might not be a good timing for that. But you're gonna have to take the RMD, otherwise you're gonna be penalized.
Okay, this question's from Eric. How can you invest in Bitcoin?
Well, to invest in Bitcoin or any other cryptocurrency, you need to open an exchange account in the name of your self-directed IRA or 401k. I don't know which one you have. But you can do that. Not every exchange offers this, but you need to open an account in the name of your solo 401k if you have one, or if you have a checkbook IRA in the name of the LLC that your IRA owns, and then invest, because you cannot commingle that with your personal assets. You got to keep your personal and your retirement funds separated.
Okay, this question is from Bill. Is it possible to divide my current solo 401k plan into two separate solo 401k plans to do two separate Roth conversions? This would be the option to revert back to the original solo 401k plan within 21 months without paying tax on the conversion of the plan that would decrease in value.
The short answer, Bill, is no. You can just divide one 401k plan into two solo 401k plans. If you even if you own two businesses, that are just under one ownership, you can just have only one 401k plan because there is a control group situation there. So I'm not sure I fully understand what it is that you're trying to accomplish. I'm not sure I understand what you mean by 21 months going back. Now, when you're talking about going back 21 months, that doesn't sound right. So I don't think that's going to work. Maybe you had some great idea, but I doubt it's going to work, but again, I don't fully understand the question. So if you want to reach out to me, directly happy to speak with you and guide you if there is a way.
Okay, question from Kimberly. I'm very unhappy with my current custodian and want to change. You helped me years ago, so I'm connecting for your advice again.
Well, Kimberly, we can certainly help you change the custodian. So feel free to reach out to our office, and if you want to speak with me, just ask for me, and we can have a conversation. And I need to learn a little bit more because I have very limited information here, just the custodian. So I want to learn more about your situation, and then I can guide you.
Okay, this question's from Jennifer. I filed Form 5500 EZ for my solo 401k plan and had a question on Part 5, Number 9. If the 401k plan is making an investment loan, is that considered a yes on the 5500 EZ question 9? I took it as a participant loan. Would this be a loan to the person who is contributing to the 401k plan?
Well, Jennifer, your question is kind of contradicts itself, right? You made the two statements there, and they're contradictory. So let's expand on that. You can take a participant loan from your 401k. Only you can take a loan, nobody else, because it's a participant loan. The 401k rules allow you to take a loan from your 401k. The loan is limited to $50,000 or 50% of the balance, whichever is less. And it's a 5-year loan, and you have to make amortized payments either monthly or quarterly. The rate is set at prime plus 1%. So you pay in principal and interest back to your 401k plan. Now, once you took the loan out, this is not an investment, this is a personal loan. So you took the loan out, and it's a nice feature to have if you need the cash. So let's say you had some family emergency, or maybe some medical bills, or maybe you need to take off, and you're not going to be able to work for the next few months. Well, you can tap into your 401k potentially. Rather than taking a taxable distribution and pay penalties for premature distribution, you can take a loan out. So but you got to be careful with that. So it's there. You just don't want to abuse that. Now, you mentioned that you made the investment from the 401k. So if you made an investment from the 401k, that's not a participant loan. It's just 401k lend the money to somebody else. We talked that in a previous question. Your 401k can be the lender and can lend money to somebody else. So if that was the case, then no, you do not indicate that on line 9, because that's specifically for the participant loan. So if you, as a plan participant, took the loan out from the 401k, that's where you report that. Now, what you do with the participant loan proceeds is up to you. You can actually lend this out, or you can invest it any way you want. You can gift it to me. I'm joking, of course, but I mean, the point is that you can do whatever you want to do with these funds if it is a participant loan. But if you made the investment with the 401k funds to someone, that's not a participant loan, so it won't apply.
Okay, this question is from Lisa. There's a few questions. Can I use my solo 401k to pay off my current mortgage loan? Can I loan out money out of my solo 401k to our business? And can I use my money to reinvest it into our business?
Lisa, the solo 401k plan designed to benefit you, and if you're talking about all those scenarios that you mentioned, paying off a mortgage, or lending to your business, or reinvesting in your business. So your solo 401k plan cannot lend money to your business, because that business owned by you and you're a disqualified person, therefore the business is considered a disqualified person as well. So that will be a prohibited transaction. Your 401k cannot invest in your business either because, for the same reason, that will be a prohibited transaction. Now you could potentially take the loan out, the participant loan, we just talked about this, from the solo 401k, and you can use, now it's limited to $50,000, so you're probably not going to be able to pay off your mortgage with that, but you could, if you wanted to pay off a portion of that mortgage. Will that be a wise move? Probably not, because in most cases you can get or your mortgage, a lot of us actually have mortgages that are extremely low. We had this historically period where we could get historically low mortgage rates. So why would you want to pay that off? Even if your mortgage is higher, maybe say 6-7%, you can invest your 401k funds in a tax-deferred environment, and you can get 10-12% on that money, or maybe more, depending on what how you're going to invest. So paying off the mortgage, which is tax deductible, the mortgage interest payments are tax deductible, and using your 401k, depleting your 401k for that, I don't think that's financially wise move. And again, it's limited to only $50,000 via participant loan feature, but I don't think that's a good move. And again, reinvesting in your own business is not going to work. You want to invest into, you want to find the investment that will produce the possible yield with the less amount of risk. That's what you want to do with your retirement funds.
All right, we are going to move over to the questions submitted here in the live stream chat. If there are additional questions, please use this time to type up those questions. But we have a question from Haresh. Is it possible to move funds from a Roth IRA to my Roth solo 401k?
IRS does not allow rollover from a Roth IRA to Roth 401k, so no, that is not possible. You can go the other way. You can move from Roth 401k to Roth IRA, but not from a Roth IRA to 401k. That's not, IRS doesn't allow that.
Second question from Haresh. In the solo 401k plan, between the tax deferred and the Roth, which one does not require RMDs?
The Roth does not require RMD. In the past it did, but with the recent change in law, the Roth 401k is now also exempt from the RMD.
Okay, this question's from Mark. Tax implications and what you can/can't do with a self-directed IRA fund. Is there tax-related seminar relating to self-directed IRA that is available or considered for future webinars?
Mark, we've done several tax-related seminars, and you can find them under webinar recordings on our website or on our YouTube page. So you can go there and you can search, and you'll find several there. We had invited guest experts to talk about the tax subject. As far as the first portion of your question, tax implication, well, there's a lot of things that you can do with the self-directed IRA. There is a couple limitations. You cannot invest in collectibles and life insurance contracts with the self-directed IRA, and you are not allowed to engage in any transaction with disqualified person, which is immediate family members. So those are the limitations. As far as the tax implications, again, I did mention that during the previous questions, is if you invest in an active business or in real estate that is leveraged, then there'll be some tax implications only in those instances.
Okay, this question is from Adam. He said, "Thank you for taking my pre-submitted question on tax of SDI IRA account. I have a self-directed IRA trust with Safeguard Advisors and participated in November of 2022 with a multifamily syndication as Class A LP passive investors. I did receive some quarterly distribution from that since late 2020 or late 2023 or 2024, but have not filed tax for that. I want to confirm if I need to find a CPA to file Form 990T for the distributions from that LP."
A good question. I can't answer that because number one, I'm not a CPA. Taxes is not my area of expertise, and I haven't seen your K1. So it depends on the K1 and what's in there. So if it's an IRA and if there is income that is derived from the leveraged portion of real estate, which most likely is, if you invested in multifamily syndication, then they will use the leverage. So most likely, yes. So you do need to get with the CPA to confirm your situation there.
Okay, a question from Haresh. What is the minimum business requirements to keep a solo 401k plan active?
Before I jump to Haresh, I would like to just invite you to submit your questions if there is something that you want maybe to be clarified and the previously answered questions, or if you have a new question, that this is the last one from Haresh. So we'll be wrapping up after this one. So, and I always say this, that it's not only you who are benefiting by asking, but everybody else who's here on the live call or who will be watching the recording. So don't be selfish. Ask the question, not only for your sake, but for everybody else's sake. Now back to Haresh's question. What are the minimum business requirements to keep a solo 401k plan active? Well, a solo 401k plan is considered an employer-sponsored plan. And that means that you need to have a sponsor. The sponsor can be a corporation, LLC, partnership, or sole proprietorship. Now, if what I've seen a number of times is that people, self-employed people, they establish solo 401k, and then maybe they approaching retirement, so they're considering, what is it that I need to do to keep the plan active? Well, you need to maintain some degree of self-employment activity. So you need to generate some income, okay? It can be in the same area of work, or it can be something else. Solo 401k is very beneficial, especially if you've been using that for a number of years and you accumulated assets there, and you do have an option of switching to an IRA, but IRA is not as powerful as the 401k, so you'll kind of be stepping down in a way. But as long as you're able to maintain some degree of self-employment activity and report some income on a Schedule C, it doesn't even have to be every year, but you got to maintain nominal level of self-employment activity. And if you're able to do that, then you can keep your solo 401k plan active.
All right. There weren't any additional questions that were submitted, so we will go ahead and conclude today's session. Just want to thank everyone for joining us, and if there are any questions that you have, feel free to reach out to us. We'd be happy to schedule time for you to speak with one of our experts. Our next live Q&A session is on Monday, October 6th, so we would be happy for you to join us then. And we hope you all have a wonderful day.
Yes, and as Natalie mentioned, it's first Monday of the month, and we kept our schedule, even meeting with you and answering your questions on Labor Day, which happy Labor Day, everybody. Hope you have some fun plans for the rest of the day. Enjoy it. And thanks for joining us, and have a great rest of the day.
Take care, everyone.